have this. Okay. We lost some people. All right. Hi, everyone. So I'm Shannon Murree, and thank you for joining us today. And with us, we have Peter Kinch. He's on the West Coast. And we also have
social distancing.
Yeah, he's the total social distancing. And we have George Dube as well to help us with any CRA questions and taxation and tips and tricks. So the purpose of this webinar is to hopefully kind of cut through some of the postings that people are making, get some clarifications, maybe get some of your questions answered. There may be some information shared that you may not like. But you know, we just want to make sure that investors are informed. Really, that's the main thing. And you know, how can we be prepared that we can be for potential things that are coming up? Now, if you know anything about me, I'm definitely not a fearmonger. I'm not one of those people that the sky is falling. It's just a very pragmatic person. How do we do things? Because I'm sure you'll all agree this is not the norm. So, who would like to go first? What would be the very first question? Should we touch on the deferral of mortgages and the pros and cons? Nod if you would like me to start there. Yes? Okay. Peter, you're up. Oh, sorry. Hold on.
Yeah.
Peter?
You know what? Yeah,
Sorry.
can you hear me now?
Yes, thank you.
Okay. Thanks, Shannon. And again, it's great to quasi see all of you again. Long time for some. We are absolutely living in unprecedented times, let's be honest. This is an event, I think, that I was saying to my son last night, you know, if you should be so lucky to have grandchildren, you'll be talking about these days with them. Another comment I like is the fact that sometimes when you're living in the present, when you're living history, you don't realize you're living history. History is something we look back on, but we are actually living history, making it as we speak. So the first point I want to make is anything that would be considered normal, you got to throw out the window. Let me give you an example. In the mortgage market, if bond yield, 5-year fixed rate mortgages drop with that. But today we're seeing mortgages drop, and I'm looking at the bond yields. The bond yields are at 0.73 today. If you got a pen with you, a pen and paper, write that down. 0.73. Normally you add 0.7 to that number, and that will give you the lowest 5-year rate that banks can drop to. Okay. That being the case, we should see fixed 5-year mortgages at 1.43. But instead, they're climbing. They're going the opposite direction. The bank, it's one of the most confusing things for borrowers today, because the Bank of Canada comes out and they say, we're dropping the prime rate by 1%. And by the way, prime today is 2.95%. The overnight lending rate is 0.75. Virtually every economic pundit out there is predicting that the Bank of Canada will drop a further 50 basis points and possibly take it right to ground zero. If they go to zero on the overnight lending rate, your prime rate could be as low as 2.2%. So write that down, 2.2%. Now, all of us know that when you get a variable rate mortgage, you negotiate the discount off of variable. And a week ago, I had a great conversation with a friend of mine renewing a mortgage on a rental, and CIBC offered them prime minus 96. So if you think prime, let's just round that down to prime minus 1 to keep the numbers even. If you took 2.2 minus 1%, you'd be at 1.2% on the variable. Now think of yourselves. How many out there have a discount on variable? So on one hand, the Bank of Canada is dropping interest rates. But what are the banks doing? What's happening because of this whole economic crisis? Well, the stock market's lost upwards of almost 30%. And guess what that means? It means the banks are now in a liquidity crisis. They're also worried about massive defaults. They're worried about massive unemployment. The sources of where they get their capital are fearing future price increases. So the cost of capital is increasing and at the risk of going into macro and microeconomic terms. Banks are pricing in the cost of borrowing. So as of literally within the last 48 hours, every bank in Canada has eliminated the discount on variables. So that prime minus 96 that was offered a week ago is now, and again, I talked to I was talking to a friend just an hour ago, dealing with CIBC. Last week they said, well, we'll offer you prime minus 96. Today he phoned back and he goes, no, that's off the table. No, we can't honor that now. It's prime minus 0.1. And Scotiabank has eliminated discounts completely. So again, we're in unprecedented waters. For those of you who have been around long enough, go back to 2008 in the subprime crisis and the capital markets crisis and the commercial asset-backed paper crisis, et cetera. And I think we're going to see a renewal or return to what happened then. And that was actually an increase in mortgage rates. The bond yield has dropped, but because they're pricing in what I call risk-adjusted premiums, fixed rate mortgages are actually going up. So strange days indeed. So Shannon, you asked about the 6-month interest holiday that banks are offering.
Right. Should someone take advantage of that?
Yes, but keep in mind, banks, that was a suggestion by the Bank of Canada and the government that banks should do that. We called CIBC on our rental properties and they're saying they might on a case-by-case basis allow us 4 months. This is not a carte blanche. Everybody gets a 6-month holiday. So first of all, your interest is going to accrue. So if you've got cash flow and you've got a plan and you don't have interruption of rental income from your tenants, you might want to not accrue more interest. You might want to maintain your payment. If you have a current cash crunch, and I know in my case, I got an email from my property manager in 8 of the properties we have in Alberta, and in every case, the tenants are asking for the same holiday. So if you have an interruption of your cash flow, then by all means, get on the phone now and ask for that holiday payment on your mortgage. It's a simple cash in, cash out conversation.
Right. So let's say, for example, a tenant says is totally fine in paying for rent, but maybe perhaps just wants a reprieve. So can they, if they say, well, you get a holiday from your mortgage anyway, do you think that, we should go ahead and kind of succumb to that pressure and ask for that reprieve, or just stand and try to get, the income as much as we can and hold off on that?
Well, the first thing is I think that's going to be a case-by-case situation. And I'm going to give you 3 scenarios where that would be a different answer. Number one, did your bank give you the holiday? I'm dealing with 3 different lenders on my rental properties, and I've had 3 different answers. One of them said, we'll give you the holiday on your principal residence, but not on your rentals. Okay, so that'll be interesting, won't it? So first of all, if your tenant says, hey, you're getting a holiday from your making payments, I want a break from paying mine. Well, the first question is, well, are you getting a break? And maybe it's a conversation you have with your tenant. Say, hey, if the bank's giving me a break, I'll pass it on to you. Second thing is, what's your market? Is it Alberta? In which case, if you have a vacancy, it could take 6 months to replace it. Well, then I'm going to do everything I can to keep that tenant, right?
Right.
Because he needs a break. By all means, if I'm getting a break, I'm going to pass that on. If it's in a strong market where the tenant's not experiencing, employment issues, and they can make that payment, and if I lost that tenant, I could probably increase my rent and get a different tenant. Well, then that's a different conversation, right? I'm not sure what market that would be right now. But
yeah.
So again, the answer is, I think everybody has to look at every single tenant and every single scenario as a case-by-case scenario.
Okay. Christian has a question about your liquidity comment. I'm just going to unmute you and go ahead, Christian.
Yeah, so you were talking about hey, Peter.
Hi.
Thank you very much. I appreciate you guys jumping on a call, and George as well. So going back to your liquidity thing, I've started to think a bit more about this over the last 48 hours. My first hunch was, great, interest rates are getting better, great time to refi, all this kind of stuff. And then my head started to think about, okay, exactly as you were saying, that rates were going up, and then that started my thought process around liquidity. So to get to the question is, if the banks are fearful of a liquidity issue, what we've seen, for example, in the 2008 timeframe, particularly in the U.S., is that the banks then start to pull back on limits on line of credit,
Yes.
closing lines of credit, and so on, and mucking around with them in general. So in your experience, are we headed to a situation like this, or is it far too early to tell?
So first of all, there's absolutely talk about that. I've been reading about that this morning. They may significantly hinder people. Like one comment was, if you're applying for a HELOC today, good luck. It ain't going to happen. I mean, banks are just going to go. You have to understand, we're living in extraordinary times. So anything that would be considered the norm, throw that out the window. Mm-hmm. Banks are traditionally fearful. They're traditionally skittish and conservative. Probably if we look at this from a macro level, and let's be clear, we're spitballing and crystal ball gazing here, okay? But if we look at this from a macro level, the biggest fear, the biggest danger, and the biggest unknown would be how long this whole COVID-19 virus lasts, what impact it has, health-wise, number one, but the underlying component of that is the economy. And the underlying component of that is employment. And the underlying component of that is housing market. The Achilles heel of any housing market is unemployment. Significant and sharp rise to unemployment. As Shannon said, we're not trying to be fear-mongering, but at the same time, I think it's really critical, and kudos to everybody who's joined this call, because in my opinion, now is the time to be prudent, intelligent, and analyze what are the best steps to protect ourselves and even potentially take advantage of opportunities when and if they come up. But at the same time, analyze what is most likely to happen in a scenario like this. And whenever I look at that, I ask myself, well, what's the worst case scenario? When banks ask that question, they say significant sharp increase, spikes in unemployment, which could mean a correction in housing, which could mean increase in defaults. They'll take a look at that model, right? And that's when they'll price in risk. That's when they'll look at liquidity. That's when they'll adjust their pricing. And that's what's going to have effect on HELOCs. That's going to have, this is, I'm not trying to scare people. I'm trying to give you a background of how the lenders are going to think. They're going to go through this mental process and start pricing their mortgages accordingly. And that's why we're going to start to see a slow increase in interest rates.
So do you think then, when in terms of, and as you said, new HELOCs are basically being blocked, but for existing lines of credit, do you think they're going to wait to see if the housing market fundamentally starts to get stressed before they do anything draconian? Like, I don't care if they charge me more interest. I can deal with that. What I worry about is it disappearing.
Again, we don't have any historical context in which to answer that question, because we're living in unprecedented times. But
absolutely,
if we go back to what happened in 2008, you remember in 2008 when your HELOC was prime minus a half, and all of a sudden you got a phone call from TD and they said it's now prime plus one. Mm-hmm. And it's like, hey, you can't do that. I got a contract. Well, no, you don't. So that happened in 2008, right?
Yeah.
So I wouldn't be surprised. That would be the first step. I think what you're asking me, and correct me if I'm wrong, is could it get to the point where the bank calls the loan?
Well, exactly. It's so, or the other way I think of it, used as working capital. So the other way to think about this is to say, do I need to draw on that working capital in terms of a fixed product? so that it's harder for them to call it, right? And move the cash effectively to another institution.
Yeah, and if you're deducting the interest on that, George can address the tax deductible component of if you convert a HELOC to a fixed rate mortgage and still maintain a tax deductibility. But the answer to that would be twofold. First and foremost, you mentioned the word draconian measures, and I would say that at any point that a bank were to call the loan, in other words, say your HELOC is due and payable today, that would be the absolute worst case scenario draconian measure. And the reason I say that is I don't think it would serve their best interest. I can't
but they
see.
reduce the limits though, right? So
Yeah,
they're undrawn, right? And that's my big concern. So.
Yeah, if you have access to capital that you haven't utilized,
yeah,
is it possible that the banks will say we're going to reduce your exposure to that and minimize your ability to draw on that?
Yeah.
Again, anything's possible. But at the same time, they want to still keep doing business. They want us to keep their doors open. There'll be limits to their draconian measures simply because I don't think it's in their best interest. At one point, it doesn't serve them.
So we got to keep an eye on it is basically the message.
Yeah.
So, thank you, Peter. I appreciate your insight.
Okay,
You're welcome.
thank you. Okay, so a question that I have here from someone offline was, just to confirm, this is only applicable to residential mortgages, not commercial. Yes or no?
6-month holiday?
Yes.
Or yeah, that's just residential.
Okay.
I would say if you have commercial mortgages, it's a case-by-case scenario. You got to talk to your lender.
Mhm.
I know, for example, before we all look at the banks and say, oh my God, they're so wonderful, they're giving us a break on our mortgage. CMHC is supporting that in the back end, and they're getting insurance to cover their potential losses. So the reason I mention that is you look at private lenders. If you have a private mortgage, and I know one of the things I offer is investing in private mortgages. First thing my investors are saying, well, is our private lender giving our clients a 6-month holiday? And the answer is no. Private lenders aren't doing that because they're not insured on the back end. So now you look at commercial lenders may or may not, if it's a CMHC insured mortgage, they might. If it's not, I would suggest probably highly unlikely.
You bring a very good point. Denise and Stuart, is there anything that you wanted to add in terms of private mortgages? Because I believe I know we were going to do a discussion next week, but that's kind of your forte. Is there anything you'd like to add to that? You're muted, by the way.
Yeah, no, I just self-mute because when you unmute everybody, I just self-mute so that
Thank
there's
you.
no disruption. But I mean, what we're seeing right now is a lot of people are just leaving the stock market and they're calling us and saying, can you use?
Yeah.
Oh.
And I mean, one of the other things is that the way that we set up a lot of our private loans is for development projects or renovation projects. So we're not looking for monthly payments. We've got the payment set up as ballooned once the project comes to maturity. So at this point, people aren't as concerned about cash flow on the loans that we've been doing.
And and we work with a very tight niche too, because when we do private loans, we don't do debt consolidation or anything like that where a mortgage broker might. We don't. We are very tight niches. Only real estate investors that we actually know, that we know what projects they're working on. They've got a track history, that type of stuff. Those are the ones that we will lend on, or that people will loan to us for our projects.
Right.
So it's a very tight niche, and yeah, unlike the vast amount of clients, let's say, that Peter would deal with too, in terms of people, you know, looking for loans. Like I don't deal with a mom and pop or anything like that. That are looking for money.
Very good. Okay, thank you. I just thought give your insight because that was a nice little segue. Next question was Peter. If someone is on a fixed rate, should they sacrifice paying out any penalties and go to a variable rate?
Quick answer to that is it really at this stage depends on what discount the lender's giving you. Everything in when it comes to any conversation around variable rate mortgages today, everything comes down to what's the discount that's being offered. Again, if your lender now has removed the discount and you're paying prime, I doubt you're getting a better rate. It may be that there's no benefit. If you're getting a full 1 point discount on prime and the likelihood prime is going to drop further, then you have to analyze what's your interest rate differential, what's the penalty, and then just do the calculation, the math, whether it's worth it. And again, sorry, that's a case-by-case scenario.
Of course. Another question that was given to me, what about the mortgage stress test? Any updates on that?
Well, the lenders have eased, the bank, the federal government has made a slight adjustment a few months back. And really, I think it was much ado about nothing. It gave a bit of a break. Instead of basing the stress test at the CMHC, what's the term there? The rate they choose, which was 5.19. It's dropped by about 50 basis points. You can take your contract rate. So if you, whatever you got on your fixed rate mortgage, add 2% to that. And that's what the stress test was based off. So it reduced the stress test limit by about 50 basis points, which was a little bit, but honestly, not a lot. I think the Bank of Canada is in and Bill Morneau are in between a rock and a hard place, because if they remove the stress test, they're helping the housing market. But remember, and this is really important, in places, and George, you and I were talking about this, I won't use the term of what we refer to those governments being.
I recorded that private conversation. No, I'm just kidding.
There you go.
I didn't.
I think we were calling them altruists, weren't we?
I think so.
So yeah, something like that. So the Soviet Union, our governments, keep this in mind. Which voices are they listening to? How many people, how many areas, and I know in Vancouver, for example, the affordable housing voices are louder. So if the federal government were to eliminate the stress test altogether, that could, in combination with historically low interest rates, create a surge in buoyancy into the housing market, which would be completely contrary to what the BC government is trying to accomplish, which is to really kill the housing market, quite frankly. They're trying to make the prices lower for everybody. So depending on which government is listening to which voice will determine whether they use that as a tool or not, in my opinion. George, I don't know, what are your thoughts on that?
I think that they're confused themselves. And I mean, on one hand, they'll have a number of policies that would help one side or the other, and then the contrast that 3 months later with another policy. I think I think they quite honestly have to go step back and start addressing how are we going to deal with COVID-19, in the sense of there's going to be potentially a significant hit on the economy. How hard do you want that hit? How long do you want that? How long can you afford to have people not working, unemployment? There's a lot of spin-offs there. And there's going to be some really, really, really challenging decisions, I believe, because you're either deciding if people are going to get sick and have excessive people passing away much earlier than we'd otherwise expect and want, or are we going to force out a whole lot of people who can't get jobs or not working full to the normal ability, can't afford to pay for food, housing, et cetera, mental stress, physical stress. It's quite a bit that's going to start accumulating. And I don't think that they've yet made those decisions, whether in Canada or in a variety of spots in the world.
Okay, 2 more questions for Mr. Kinch, and then we'll move on to George, lovely George. So closings, do you see closings on real estate transactions still continuing?
Yeah, I think
financing?
I don't think there's going to be an issue in closing. I think it might be an issue in timing. The one thing that's very important to remember is that at every lender, if you're working with a mortgage broker, for example, and the broker's working with underwriters at various lenders. They've all been told to go home, so they're working remotely. In some cases, that's a seamless transition, and in other cases, not. I was talking to a lawyer yesterday, and he said all his staff is working remotely. One of his conveyancers was having difficulty figuring out the software to plug in. So there's going to be logistical challenges. There's going to be disruptions, and I think we may have flexibility in timing, but I don't think in general terms it'll make any significant change in closings. If a contract's in place and the closing's set, it might get delayed, might get interrupted a little bit, but it'll still close.
Okay. Do you know if an investor would need to prove financial hardship to time for renewal? I'm not sure if those are two questions
I don't
in
understand
one.
the question.
Yeah, I'm sorry. I'm
At
done
the time for renewal, what's the specific question? Are they asking about to get a break on their payments?
Yeah, the
or-
question was, would an investor need to prove financial hardship, and would that cause challenges at the time of their renewal? I guess I should have asked for more clarity on that. So I guess, so we've got the 6-month grace period is what they're asking for.
Just to be clear, I want to clarify that 6-month grace period. I think that's getting overstated. It's not
Okay.
a carte blanche 6-month grace period.
Excellent.
It's a suggestion. A
Okay.
suggestion from the federal government asking the banks to give it on a case-by-case basis. Not all banks are honoring it.
Thank you. I did that on purpose because I know everyone's just assuming that that is a given. So thank you very much for clarifying that.
And it's not a given that you're going to get it on your rentals.
Exactly. Okay, Mr. Dube, how are you, sir?
I'm awesome. Thank you. All things
Yeah.
considered.
Exactly. We're doing our best, right? So, given the recent announcements of the forgiveness of the extension on filing for CRA, and do you think that that is advantageous for someone, or should they continue status quo?
I think for the most part, people should be taking advantage of it. If it's not going to cause additional interest charges, we're just describing with Peter in terms of how we might be hit from a cash flow perspective over the next period of time. So if there is a balance owing, provided that's not going to negatively impact mortgage qualification or renewals, then I would rather be holding on my cash right now, and whether that's to potentially meet a cash flow need, or alternatively, when we're on the other side of this, whenever that may be, I would love to have a war chest, because not everybody, unfortunately, is going to do as well with it. And so, one, I want to protect myself, and two, yes, at some point, I would look for opportunities.
Okay. What are your thoughts and insight on what's going on?
For me, it's trying to reassure clients that their particular business plan may have been great 2 weeks ago or a week ago. Maybe it needs to be adjusted now, but to go back to some fundamentals of, let's take a look at cash flow. Cash is still king. And if we're going to be squeezed with respect to tenants, not having confidence that we're going to get a holiday in terms of mortgage payments, and recognizing, again, the mortgage payments, while significant, that doesn't mean I get a holiday on my property taxes, my utilities, my repairs and maintenance, and other costs of supporting my real estate. I would just like to see that there's a war chest there that I'm accumulating to the degree I can, perhaps have available, look at working with Peter and his team, or the advisors, to, okay, what should I be doing with my mortgages? Should I be refinancing? Should I look to pay off some certain properties, or change what I'm doing? How do I get access to capital? One of the questions was there, and I agree with the sentiment, is not so much as concerned about what the interest rate are, but really concerned, do I have access to capital? So I think people need to make that as a priority for their planning in the next couple of weeks, to have those discussions with the advisors, and then, okay, now let's sit down and figure out, from an income tax perspective, what should we be doing? Right now, quite honestly, in terms of extending personal tax deadlines. I guess it's a good idea in the sense of, sure, the deadline is extended, but I mean, for most accounting firms, for example, I'm going to have the majority of my personal tax team on May 1st be unavailable to me. So in other words, if I don't get those tax returns done by April 30th, now I've got a problem. I can certainly let some of them slide, but I'll have people now jumping off into corporate, and I'll have people returning back to school in terms of some of the entry level positions we have. So it's nice to say the deadline's extended. It doesn't mean that the work would get done after the deadline, and I don't think our accounting firm would be significantly different than most. And then if we're talking about the quantum of the personal taxes, and I think a lot of our clients, sure, would they prefer to, or would they like the opportunity to defer those taxes? Unquestionable. How, again, and assuming it doesn't negatively impact borrowing capacity, etc. But most of my taxes at a corporate level, which is a completely different game that I'm playing with. And the rules that were extended, they impact favorably family trusts, as an example. But we haven't had that same level of concern from the government with respect to corporations, partnerships, some other business entities. So it's really, really, really geared to the individual. And a lot of investors, they don't do it personally. They're bigger than that. It's a little bit more of a true business as compared to owning a couple of properties personally. So it's almost, to a degree, it's window dressing is my concern. And there are implications, but if I could weed out all of the potential side effects, if the government's going to give me an interest-free loan, sign me up every day, I'll take that.
Mm. What would you advise real estate investors, and how could they best prepare?
I think it's having that honest assessment, taking a step back and I mean, as an accountant, I guess I love to see some spreadsheets and take a look at my cash flow, what some of those expenses are. I need to, right now, my best friend has to be my mortgage broker, because they've got a huge impact right now in terms of what they may or may not be able to do, and appreciating, I'm sure they're going bonkers just because they don't have the magic ability to say, yeah, don't worry about it. CIBC is good with me, or TD is good with me, or whatever it may be. I'm sure Peter would love that ability, but hasn't been given the magic switch. So I think it needs to be over the next little bit, that the banks don't know how. I mean, they were kind of more or less told about it via basically a press announcement. So they're trying to figure out rules, and we're seeing clients where they're asking us now in terms of being able to apply for earlier employment insurance and some of the other government programs that have been announced. And what people missed in that conversation, I think in many cases, was that they were hoping there might be forms available for people in April. They don't have that. Like, in checking with the department, I mean, this is something that normally takes months. This isn't something that takes hours to do. And so again, they, I'm sure, had a little bit more of a head start than the press announcement, but they really didn't have much longer than that. And there was no way, even remotely possible, that they had a week's notice. So they're, in fairness, I think, valiantly trying to put things together, but they've been given a Herculean task to do. So I think we unfortunately have to have some patience with respect to acknowledging that this is a large bureaucracy, and even if it was a nimble machine, it would still take time. So my guess is there's people there that, again, just going bonkers, trying to do everything they can to help people, but there's only so much they can do at one point in time.
How has this changed how you've done business?
Ignoring the kind of the work out of the home part, as you can see, and which I'm sure is quite familiar to many people right now. And really, in fairness, for my family, not that big of an adjustment because of Robin's situation last year. We got used to working out of the house, if you will, for at least periods of time. So everything was kind of ready. So the actual conversion was like a 5-minute process. That wasn't a big deal at all. Our probably more practical thing would be we would tend to, from a family perspective, analyze our properties, business activities, financial objectives, etc., during the summer, where it was just a little bit more leisurely. There's a patio outside, ideally a glass of wine or two, maybe three, depending on the topic. And we would go through things and do that planning. Whereas right now, it's forced on us today, I think, from a practical perspective, and acknowledging, again, when some of the news first came out, okay, not a big deal, I got to work at home for a couple of weeks. But when you start seeing and paying attention to what's happening overseas and start doing, oh, wait a minute, this isn't a 2-week process, what is going to happen to my cash flow? I think, if we're all being honest, nobody knows. I mean, we can have different theories. We can start to estimate what some ranges of possibilities are, but we truly don't know. And again, back to, again, for Robin and I anyway, we were probably dilly-dallying in terms of refinancing a couple of our properties, where now, yes, in hindsight, really wish that was done 2 weeks ago, perhaps. But it's also an opportunity, in our case, maybe, and Peter may correct me, but should we change the type of financing we have? Should we take some of our smaller properties and have a commercial mortgage, for example, onto them? How is that? One of them, we're kind of in a process of refinancing a few apartment buildings small apartments that we had. And again, the 10-year interest rates on them were like glorious in my mind. It was going to save quite a substantial amount of money on an annual basis. Well, maybe I should do that with other parts of my portfolio. And I don't know if it's possible. I think it is, but I don't know for sure. And as Peter's talking too, it makes perfect sense to me to say, wait a minute. Yes, the Canada perspective may be declining, but that risk premium, it has to go up. That makes perfect sense to me in terms of that side. So maybe I'm going to have an access to credit problem, or am I going to be able to refinance a couple properties, have a fairly large then amount of cash that's available to as needed to get into the portfolio, so that I don't have a row of dominoes. And then start working with possibilities of, hey, wait a minute, I kind of like this property or this class or doing this. And I rightly or wrongly, Robin and I were looking into doing a number of second mortgages over this year. And now, no, I don't want to deploy my capital. I'd rather keep it so that I need some conservatism, if you will. I want to make sure those mortgages can be paid, because I'm not going to rely on the bank to say, it's okay, Mr. Dube, you don't need to make a payment today. And I'm not sure when that's going to start or stop. If they do say that, that's wonderful. But I know I'll have other bills. So so to me, it's building up the war chest. And how do I do that? How do I plan for it? It's not the greatest of times as an accountant, to be trying to do some of the business planning on that side, but that wasn't our call to make. That was the good Lord telling us, now's the time.
So that's a very good segue. I have a question for both of you. I'll start with Peter. If you were an investor starting out today, would you invest?
Right here, right now, I would not. I would, if I had capital available, quite frankly, I think there's too many unanswered questions. I do think there's significant opportunity ahead, and cash is going to be king. Keeping your powder dry right now, as George alluded to, in my opinion, would be the smartest, most prudent move. If we play this out, okay, and again, there are thousands of questions that nobody can answer because we just don't know. But let's just say that the COVID-19 issue and virus is worse than some think. Let's say it's worse than President Trump thinks.
You went
okay,
there.
we won't go there, sorry. But I've read and been informed by people in the medical community that the real explosion of this could come from the United States and could be extremely disruptive. And we haven't even seen the beginning of it. So again, there, at the risk of fear mongering, let's say we temper that and cut those, worst case scenarios numbers in half. no matter how you slice it, there's going to be disruption, okay? When there's disruption, the area I would watch, if I'm a real estate investor today, the single biggest area I will keep my eye on is employment numbers. Because as a real estate investor, we all know that's your Achilles heel. Lack of employment means lack of ability to pay rent. Prolonged vacancies, and I don't need to preach to the choir here. Everybody knows that prolonged vacancies can be very impactful on your ability to carry mortgages and carry other, as George said, even if the bank gives you a holiday, there's other expenses. And let's say the bank gives you a 4 to 6 month holiday, but your tenant problems go on for 12 months.
Right.
Well, okay, so let's just all play this game. How would that translate in the broader economy? Not just amongst this group, but on a broader scale. You'd see an increase in defaults. You'd see an increase in foreclosures. You'd see, and as you play that out, what does that do to property values? So the person sitting on cash, it's no different than what people, if we're having this conversation about the stock market, right? There are many people who feel this is the perfect time to jump in and pick up stocks cheap, right? Yeah, it's crashed. Well, that's when the Warren Buffetts of the world jump in, right?
Mm-hmm.
So the same is true on the real estate side. It's just that might take 4 to 6 months. So I could envision a time where there's a very good opportunity for those sitting on cash to jump in. I'll give you an example. One of the companies we work with is Centurion Apartment REIT, and they own 75 apartment buildings across North America. One of the concerns I had is how would the disruption of rental payments affect them? They were actually closed, and yesterday they opened up. And I was really surprised. I went, why would you be raising more capital? And the president of the company said, we are seeing unprecedented opportunities within the next 3 to 6 months, and we want to build up our cash in our war chest so we can pounce on it. I would say that would be my advice to real estate investors today. So
stocks, would you do stocks over real estate?
No, okay, let's be really clear. I really am adamant that that's not that's not the right question. It's not one over the other.
Okay.
In your RSP portfolio, you may have exposure to stocks, and that's not because it's better or worse. The whole conversation around stocks, it has a role in your overall portfolio. I'm a huge proponent of a hybrid. Don't put everything into one basket, regardless of what it is. If I was looking, I like to look at it as 3 succinct buckets. I have my public money, stocks and bonds. I have my private equity, which could be mortgages, REITs, or other private alternative assets. And I have my direct ownership of real estate. I split those into 3 succinct buckets. Specific percentages of my overall assets are in each of those asset classes. And then I allocate those funds accordingly. So if I'm looking at that stock bucket and I'm thinking of, and I'm sitting on cash in there, yeah, it might be a good time to jump in. Or I might just wait another month. Mm-hmm. I mean, I don't think this thing's going to correct itself any day soon. Having said that, the one last thing on the stock market, what I'm reading is the significant crash may be at a bottom only because the markets have actually priced in discounts 3 months out. So they've already anticipated significant issues 2 or 3 months out. And that's why there was such a run on the stock market, because they were preempting it. So in other words, the stock market is actually ahead of the curve. So whereas now might be close to the bottom, entered that cycle on the real estate side. You'd have to wait 6 months to see what the buying opportunities are in real estate.
Interesting. George?
I would largely agree. Actually, there's nothing I disagree with what Peter said. I guess in terms of adding to it would be, I think there's going to be shortly a huge opportunity for experienced joint venture leaders to be working with some of the less experienced real estate investors, particularly if the experienced investors have been around for a recession or two. I think that type of hand-holding is going to be, one, crucial, and two, very, very reassuring for people. I think we'll also see those people that, again, have some cash. Maybe instead of doing a traditional 50-50 joint venture, all of a sudden, maybe it's 60-40, 70-30. Their value could be worth a lot more than it perhaps is today or a week ago. On the other hand, playing the devil's advocate, if I've got that experience and I've been through a couple recessions and have seen this and done this before, and that person has oodles of cash and just no idea what to do with it, maybe it should be a 60-40, 70-30, but perhaps just the opposite of what we were thinking in terms of the cash side. So again, for somebody with experience, I think there's a huge opportunity sitting there. From a income tax perspective, again, not that, again, very, try not to come off as a vulture by any means, but with the stock market down, great opportunity for tax planning. And it's something I think people should be talking with their advisors. If they're doing estate and succession planning, there's a huge opportunity. I think that opportunity is going to potentially extend to the real estate side, as Peter was talking about. We're not sure what the values of the real estate's going to look like in a little bit of time, or at least certain perhaps classes of real estate. And if there's a temporary or longer term decrease there, as much as we don't like to see decreases in real estate values typically, well, particularly a temporary one, there's some tax opportunities there. So while clearly we would rather not go through the experience we're all going through right now, let's try and do with it as we can to see. Let's not waste some dollars, I guess, and acknowledge that, yes, we need to do all we can to protect our family and our communities, but on the same token, part of that protecting the community is for us to do well on a long-term basis, not just worried about the next few months.
Exactly. And then to your point as well, and to Peter's earlier is, so even that's probably another conversation in itself, is how do we handle the joint venture? Because you're giving your value and your expertise, but at the end of the day, we're putting it all in the financial hands of our customers, which are our tenants. So because none of us know that, and we're talking about a high unemployment rate most likely, that's not a guarantee now in terms of vacancy that we can add. Like, so I can see it being very challenging. Like, even for me being a realtor, how am I going to sell that to my clients? I'm not a magician. I don't know. And it's going to be very challenging times as we try to recover through this.
It will, but let's also not try to pretend that everybody's losing their job. I mean, there's going to be quite a number of industries that will, I mean, the accounting industry is one, and I expect Peter's is very, very similar in the sense of, I can work at the office, I can work at my house, I could probably be in Antarctica, I could be at a cottage. For the most part, that's not going to have a large impact on my ability to service clients and to work with them. Yes, obviously, if the economy is doing poorly, there's not going to be perhaps as many wonderful assignments and whatnot that are going on. But on the opposite side, we're going to have clients that want some protection and some hand-holding. So to a large degree, that's still going to exist. People that are in the medical industry, more than ever, they're going to be needed. They're going to have great jobs. So I think it may be unquestionably that some tenants are going to lose their job. No doubt about it. But let's not pretend that's everybody. So with, I think, some good property management and skills, not that there won't be some hurt, but it doesn't necessarily mean that it's going to be an overwhelming disaster either.
Very good.
One thing
Peter.
just jump in there. I agree 100% with what George said. The only thing I would add is the term I would encourage everybody to really use today is managing expectations, because not everybody's going to lose a job, but your tenant could. So all you got to do is manage people's expectations. And I'm a profound believer is that you analyze, well, what's the worst case scenario that can happen? If I manage for that but expect the best, I'm covered. And as long as I don't overpromise and underdeliver, if I have a joint venture and we're going into a deal, and I say, look, here's what potentially could happen. Are you comfortable if our worst case is still okay? And manage their expectations like that. And then anything that is better than that, they're thrilled with it.
Right. Is there any reprieve for self-employed, George?
Not well. It goes back to on the from a personal tax perspective. If they're self-employed as a proprietor or a partner, yes, that can be, but organized in a corporate environment or something more significant. As of right now, there's not the reprieve that otherwise exists,
Right.
or is about to exist conceptually.
Okay. Right. Because I know that,
Yeah,
like,
sorry, I guess I shouldn't have said it quite so fast, because there are some programs in the sense of helping with wages for small business and things of that nature. But
Okay.
again, right now, that's all conceptual. It's a press announcement material. We just don't have any, again, we don't have any forms or things of that nature. So I shouldn't have said there's no benefits that way, but it's not perceived to be well defined as on the personal side.
I see. Because I mean, I was taking into consideration like the small businesses, you know, they could have like a staff of 5, and, you know, right now they have to have them all off. And if they didn't have enough of a fund, or perhaps, you know, retail or restaurants. And I mean, it's, you know, everyone being involved here. Just, is there any reprieve for, you know, those individuals who have other staff to support?
Again, I think there's some protection coming, but it's really minor if you do the math. Otherwise, they're looking for, and again, I don't know how it's defined. Peter probably would know much more about it, but through, I think it's through BDC, perhaps, that there may be some additional programs conceptually coming, but I don't know if they've actually got it nailed down by any means.
See. Okay, I have a couple of questions here. As investors, are there any programs that we should be tapping into? For example, self-employed for some, or payroll credit for others, etc.
Yes, so in terms of the payroll credits, yes, there's something coming, but that's again back to they hope to have something available in April, essentially, and it's concept right now.
Right. It's all, we're kind of all flying by the seat of our pants, right? They're trying to reestablish.
We are. And even I checked this morning because I had a number of clients asking me the same question. Great questions. There's nothing wrong with the question at all. It just, again, I think the Department of Finance, Revenue Canada, as much as I have some critiques over the years about them, I think right now they're all hands on deck trying to help out people, and they were good enough to begin slowing down some of the what I'll call typical audit work, so they can concentrate. They're trying to help at the end of the day, but they can't magically do something overnight.
Right. Of course not. Okay.
Shannon, I just
do you have anything to add, Peter?
Just a thought on the all hands on deck thing. A tip for real estate investors dealing with getting the mortgage holiday. The people you like, I'll give you an example of what happened with me personally. I immediately contacted my long-standing personal banking manager and we've had almost. And I say, hey, I want to get ahead of the curve on this. Can you help me out? Because, you know, we've got like a dozen mortgages I need to address. Immediately, the answer was, well, sorry, not immediate. 2 days later, I get an email response, not phone call. And it basically is, call this 1-800 number.
Oh, wow.
Okay.
Yeah. So, and then at the bottom, please rate my service so I can get an award. No. So then you phone the 1-800 number. Well, guess what you're getting there? You're
Automated?
getting an extremely low-level individual who has no freaking clue about what a rental property is. Okay, that this individual's ability to comprehend the fact that I have tenants that might be having issues. I mean, so and you can literally see the individual on the other line of the phone look down, flip through a few pages, read a statement saying, you know, that's just my point is this, be patient with that process and don't accept the first no, because you're going to get stuck. They're so overburdened. As George said, all hands on deck. You're going to get a low-level person, quite likely, who doesn't comprehend your business. And just say, hey, I appreciate, my advice is when you get that person and they say, no, we can't do that, you say, I appreciate what you're saying. Do you mind if I could get this escalated to somebody who has a better understanding? Or you know, without insulting them, say, could you please escalate my concern?
Mhm.
I just want to throw that out there as a.
That's a very good point. I was on a webinar last night with Rain, and they were, you know, saying that they were on phone with for hours, you know, trying to reestablish, go through like their lines and you know, lines of credits and fixes. And you really, I mean, we all really have to dig deep in terms of, you know, our patience. And if you don't have it, meditate strongly and before you go, and avoid caffeine, I think, before you make the calls.
Well, I think the message I'd like to really emphasize is that everybody who's on this call is not the norm. We, by virtue of what we do with having multiple rental properties and real estate related businesses, you don't represent the norm out there. 95% of all mortgage holders only have a single property, the principal residence, and you could only imagine the 1-800 number is getting inundated with phone calls. And the queue that's building up is enormous. And 95% of those phone calls are a single family home, residential mortgage. And you say, well, hey, I've got 5, 10, 15, 20 properties. They go, what? Yeah, it's above their pay grade.
Right.
So
Right. Exactly.
anticipate it and manage your own expectations. But you don't have to take no for an answer. Just ask, politely ask to get escalated.
Exactly. Especially for, you know, for having a large portfolio like that and previous relationships. So now previous relationships are tested, right?
And again, the frontline people don't even know what they're doing. Everybody's flying by the seat of the pants. This is all new.
Yeah. I used to do tech support. So I remember I would basically be that person on the mouse. If customer answered point B, here are your options A, B, or C.
Yeah.
If customer answers this one, go to this. Yeah, I remember that chart. Yeah. I have another question here. Should investors be looking at selling their properties now, considering they were planning on doing this? Okay, yeah, I think that's one part question. So should investors be looking at selling their properties now?
My personal answer is, again, it's going to be case by case. What's your personal finance? Do you have a liquidity crunch yourself? Is there a reason you need to be selling? What's your motivation? Honestly, if you got cash reserves and you have good quality real estate and you can ride this out, then just ride it out. Whatever you sell for today is going to be at a discount. It's like stocks. It's whatever price you're at now is going to go lower, but not forever. And then it'll bounce back and it'll come back. And again, depending, if you're in an oil-based town in Alberta, that's a different conversation than the KWC market in Ontario, right? Or Barrie. It's all different.
I think most people, not all, again, there's certainly going to be contrary examples. If they look at things on an after-tax basis and then consider transaction costs and what's going on, they in far more cases are better off to keep the properties. If anything, look at releveraging or prepare. The time is right, whenever that may be. I frequently go through calculations with people where we look at, forgetting what's going on today type of thing, but where we analyze, well, somebody wants to get a larger property, for example, so they consider selling the first property and getting the second. Sometimes that makes perfect sense, not suggesting otherwise, but often that tax difference, if you will, assuming the first property was a decent property that should be held, maybe I'm losing 5-ish% of what I'd otherwise get on a refinancing, compare my refinancing with a sale. But now I've got 2 properties that I'm getting appreciation on and principal repayment with. And to me, if I measure then 5 years from now with some reasonable assumptions, I'll be far better off to have both properties. Again, that makes a number of assumptions, but as a general comment, it wouldn't be my first thing to want to be selling. I mean, and quite honestly, I'm a real estate investor, not a seller.
Yeah, and if I can jump in here, I asked the question because I had contacted Shannon, I guess late fall, winter, saying, hey, listen, we're going to be selling this condo. I really do not want condos in my portfolio, and I have one. I want to get rid of it. Like we were talking just 2 weeks ago, I guess. And then this happened. I thought, okay, now what do I do? Do we continue to sell it? Because the mortgage is coming up for renewal. So it's a question, I sort of didn't want to renew the mortgage. I was going to get rid of it. And I'm going, okay. So the question mark is there now for us, and it was kind of I posed because my a recording or not, Shannon, but there may be other people in that same situation too that would like to hear what exactly is happening, because they're at that point. They were planning on selling because the mortgage is now coming up due. What do they do now? That was basically, so that was kind of my question because of our own personal situation, wanting to get rid of that one condo. We're one of these people that our condo fees, our insurance that is tripled last year. So there's a lot of stuff happening, you know, with condos, and we just didn't want to keep a condo. That's it. I don't know if anybody else has more comments to add on that.
Well, one comment I would add on that is if the potential purchaser is an investor, what would their motivation be for buying that asset class at this point? And if they were going to jump in and buy a condo to add to their portfolio, are they looking to get a deal? The answer is probably, I mean, we know the answer, right? If you just reverse the tables, if you were the one purchasing that condo, you'd be looking at this as an opportunity to get in, get something cheap.
Yes and no, I kind of sort of agree with that, but I don't, because I know that particular subdivision where I have a handful of investors who want in that complex. So it's just kind of one of those niche opportunities. So I mean, the only downfall is you know, the increase of the condo fees, but other than that, it is a kind of it's a niche. Yeah, it's a niche. I'll stick with that. And to add to that, I have the schoolhouse project on Penetanguishene, and I have to say, and the client's not on the line, but I'm shocked that we sold it. I have to say, again, it was a condo, and with student housing and everything going on right now, and the fact that we were able to sell that, and she stuck to her guns, we had it at $389, I believe, and then with the condo fees and everything, and she was able to successfully, she stuck to her guns at the $375 mark, and it only has 4 rooms, and they rent out each at $650 inclusive. But it was a niche. The person who bought it just ended up buying 3 others in the same complex.
And if the property could be owner occupied, that's going to have a different set of criteria. If somebody just needs to buy something, or that's what they want, then the market's going to be not going to dictate those terms.
If I may ask, Denise, does that answer your questions? Oh, you're muted still.
Mm-hmm.
Thumbs up.
I was pushing the wrong button for I doing. Yes, it does. I mean, it's still the question is, do we move forward or not? I mean, we still have to make that decision, and we'll have a side chat anyways, Shannon, on that. Mm-hmm. But like I said, I'm just putting it out there because other people may be in the same boat as well.
Yeah, exactly. Should you renew or at least like for another year and hold on to it or sell? It's a, you know, because we just don't know the market.
Exactly. But in Ottawa right now, we're still in multiple offer situations at this point. But mind you, that's not in Ottawa. That's more out your way, Shannon.
Yeah, we honestly, from a real estate aspect, we are still seeing multiple offers. And what people are doing is they're listing, and it's just changing how we do our business. And, you know, we're doing things virtually. I have clients who want to go see properties, and I am self-isolating. Same situation as George Dube. You know, I'm taking care of, you know, my mom. And so with her vulnerability, I'm being very, very careful in how I do business. And so but I'm still working, and I will go show vacant properties, or colleagues in my office will give me an update that they have a property coming up, knowing the criteria for my investors, and they're doing virtual tours for me because they've already been in the property and they're the selling agents, and they give me a heads up, which I think is really cool because, you know, they know that I'm an investor agent and my situation. So I'm seeing a lot more cooperation that way, which I think is very, beautiful of some colleagues, and they're listing, and then they're saying, okay, well, no offers until XYZ, and we're seeing still firm offers and over asking. Crazy. So I haven't seen the low ball offers yet, but I guess it's coming. Peter, how is loaning right now for buyers? I mean, that's a great segue. So if, let's say, Denise does go ahead and put her property on the market, home buyers, are they able to qualify? Like, is it a fairly easy process given the uncertainty right now, or are there challenges a home buyer may face?
A home buyer as opposed to an investor, you mean?
Yes.
I don't think the criteria for qualifying for a mortgage has changed.
Mm-hmm.
I mean, really, it's just timelines.
Okay.
Purchasing. I mean, I was just reading something here earlier. The priority for banks right now is purchases with firm offers. Then you that's number one, and number two is pre-approvals. And last on the list is if you're looking for a refinance, that's at the absolute bottom of the list. They're pushing those out, and it's going to take you forever to get to those. But the timeline will be delayed, but qualifying at this point has not changed.
Okay. Are there any other questions before we go? Thank Mike Kostrich from Barrie. He says he totally agrees with Peter and George. Patience is the key, as is diplomacy in speaking with everyone. So I agree with that. It's basically having conversations with our tenants, and they are our customers. And on a call last night, someone was saying, well, I have these tenants who are taking advantage of the situation. And again, have that conversation. And if they're non-paying, do you still issue N4? My opinion, we'll have a property manager on next week, but I would say yes, still continue as status quo, just so you have the paperwork, just as you're continuing to run business, and then just have conversations. Or how can you facilitate and help your tenants with the paperwork as well in maybe that rent relief? So then if you can still get paid, it makes you look like the hero for one with your tenants, and then you can help facilitate and oversee that. So thanks everyone for your time. Is there anything else anyone would like to add before we wrap up? You can unmute your we're going to wrap up because we're over the hour. And Peter, George, thank you both so much for your time.
Thank you.
And is there anything you would like to add before we close?
Focus on cash flow right now, after focusing, of course, on the more practical of family and community. And now's the time to start to look at things. And maybe if nothing else, that's a small blessing in disguise. It forces us to relook at what we're doing.
And my last comment would be to be careful with any assumptions you make, because whatever is normal is no longer normal. We're living in unprecedented times. That doesn't mean you have to freak out and panic. This means you need to be prudent and go with the flow. Be flexible and adjustable. And as George alluded to, cash will be king, and cash flow is very important.
Exactly. And if I can wrap up, everyone who's on this call, you're all leaders, or you're looking for information. So I think it's really our job to support the narrative in a positive, influential way that we can be, and seek out your friends and colleagues, as we just work through all this together. I think it's definitely teamwork, for sure. So thanks everyone for joining us, and I hope that you got some information. If you need to find George or Peter, George, how can they find you?
Easiest way is email gdube, D-U-B-E, @bdo.ca.
Peter?
Peter at peterkinch.com, PeterKinch.
Perfect. Okay, thanks everyone.
Okay.
Thank you.
Take
Thanks
care.
for
Be
organizing,
safe.
Shannon.
Thank
Okay.
you. Be
Stay
safe.
safe.
Bye-bye. there you have it. So we had some information from our experts, and thanks as always. And if you have any questions, you can reach out to me. I'm Shannon Murree, movingsimco.com, and we want to wish you a safe day. I'm not going to say wonderful, but we're going to wish you happiness and health, and stay safe out there. Take care. Bye.